Hey guys, welcome back to the channel. So my favorite crashes are when the whole stock market is crashing due to macro environment concerns. And this is because you tend to find many deals out there of stocks that you wanted to buy. And this is different than, for example, if the indexes were going up and you had a specific stock that you want to buy or that you hold. And if that is crashing, you have to start reassessing the fundamentals of the company. Why is that specific company crashing? And ultimately, it could be it's crashing and it's still a good buy. However, it is more company specific. But when it's the whole market, you tend to find very good deals out there because the crash is disconnected from the fundamentals of the company. And right now we're in a macro environment with geopolitical issues, with the Fed raising interest rates and quantitative tightening. And this has led to a market where valuations are being compressed, especially growth and non-profitable companies. When it comes to the current earnings season that we're in, we clearly see this because companies that didn't show crazy high growth like Facebook, Netflix, PayPal, Roblox, they were hit by 20-25%. And this is ultimately the market cycle that we're in where valuations are compressing and there's a risk-off sentiment in the market. So in this video, I want to look at Palantir after earnings and see how it fits into this market cycle, and look at some valuation metrics to see how low it can potentially go, whether it's a buy, hold, or sell. And as a disclaimer, I own Palantir, which means that I clearly think it's a buy because every day that you hold a stock is basically reaffirming that you would want to buy it. So before we get into the video, if you can please like and subscribe in order to support the channel. Okay, so first, unfortunately, I cannot tell you exactly where Palantir is headed, whether it's going much lower, whether this is the bottom. And anyone who says that they know where Palantir is going, I think you should be very skeptical about what they're saying. Because, for example, if we look at Palantir, it has a 13.5 price to sales ratio, while, for example, a Snowflake has 75. So you can look at them and say, oh, they're undervalued comparable to a Snowflake. But when you look at them comparable to the NASDAQ and S&P 500, which have an average price to sales ratio of about 3, then you can say, oh, Palantir is overvalued. Although obviously we would have to factor in the growth of Palantir, which is probably going to be much higher in the coming years. However, the point is that the valuation of Palantir is so connected right now to the macro environment, which is basically connected to what inflation levels will be, the interest rates based on that, and really emotions in general because of the market cycle. And this ultimately can say, okay, Palantir's 13 price to sales ratio is a bottom, or we're going to cut that in half and the price to sales ratio going forward is going to be 6.5. And this means still get cut in half from a $20 billion market cap to a $10 billion market cap. And this is why it's very important to focus on the long-term metrics that you believe Palantir can get to in terms of their revenue growth rates and their earnings. And then based on that, you say, okay, if it's valued at 20 billion today, then I believe that it's undervalued because it could be valued at 100 billion or 150 billion or whatever you think. And this is why I'm invested in it. Looking at it today and understanding where it can get to in the short term is too dependent on the macro environment. So you cannot invest if that is your outlook. Now I want to get into the growth metrics of Palantir and see from there how the company will be valued if we go forward 5-10 years. And then based on that, what the actual stock price can be. And what I would say is you have to have the belief that Palantir has a specific moat that is unrivaled, that their data analytics is really going to be the operating system for many governments and corporations. Because without this, then yes, you can say Palantir is overvalued. Now, although that Palantir dropped substantially after earnings, they still beat on revenues. And yes, they missed on earnings per share, but I would say that's a metric that I don't focus on yet because it's not about their earnings. It's about growing the company's customer count, revenues, and their deal value going forward. And ultimately, they reaffirmed their guidance until 2025, 30% annually. So nothing changed there. Now, it could be it had to do with also the earnings call. Alex Karp is an eccentric individual who dropped the F-bomb a few times and is just not your typical CEO. So it could be that investors were scared away, including Cathie Wood, because of that. But the point is that nothing has changed in terms of their long-term guidance. So it feels like it's just got caught up in the classic market cycle that we're in. Now, if they do grow 30% annually until 2025, then they would reach 4.4 billion in revenue. And at the current stock price, that would be a 4.6 price to sales ratio, which for a company that, again, ultimately you have to believe that 2025, they're not done their growth. I take it that they're really in their infancy stage. They're right now building out their sales team. And with Foundry, they're starting to really tap into the commercial side of their business. And this means that I believe that between 2025, 2030 and beyond, they're still going to be putting up double digit, probably 30% plus growth rates at that period. I see it as a company that has the potential to tap into exponential growth because as companies like an Airbus adopt their technology, their competitors will be at a disadvantage if they don't use Palantir, which I see as the top data analytics company out there. Now, based off that 4.4 billion in 2025, if, for example, they have a 10% profit margin, and I was looking at the different profit margins of, for example, a Salesforce, an Adobe, Oracle, and IBM, and obviously I have to look at companies that are profitable, which a lot of SaaS companies like Snowflake and CrowdStrike are not profitable. But if we put a 10% margin, then they're at 440 million. If we put a 20% margin, 880 million, and a 30%, then they're at 1.32 million, which would either put it at a 50 PE or a 25 PE or a 16 PE. And again, I believe in 2025, they're still going to be in that growth mode. If anything, it's going to really take off then, because that's when companies will actually know what Palantir has to offer. Now, if we look forward again till 2030, if they continue that 30% growth, and they would be at 16 billion in revenue. And if we look at 20% profit margins, then that would be $3.2 billion. And if we look at 30% margins, then it would be $4.8 billion. And this would put them at the current stock price at a 6.8 PE or a 4.5 PE. So really, you have to look at Palantir. You really have to take out all the short-term noise. No one can tell you exactly how low it's going to go or if this is the bottom. You have to do your due diligence, understand the company, and if you come to that conclusion that this will be one of the most important data analytics companies going forward, where it can truly use AI to compartmentalize and analyze data for companies and governments to give them that advantage, and this will ultimately lead to exponential growth rates and profit, then it will reflect in their stock price. Then it could be a good buy. And obviously, it's not for everyone. Some people can't see their portfolios drop by that much, and also it's not an easy company to understand. So if you don't understand it, then maybe it's not either the best investment for you. But again, make sure you're doing that long-term research. And in general, beyond Palantir, you will generally be rewarded by this research. So I hope this video was helpful. Please like and subscribe to support the channel, and I will see you in the next video.